Well, the centre's plan to resuscitate public sector banks through a mega recapitalization plan has very clearly been welcomed by the Reserve Bank of India. In a statement, the RBI Governor Urjit Patel said that well-capitalized banking and a financial intermediation system is a prerequisite for a stable economic growth. Patel, in fact, also added that the government's decisive package to restore the health of the financial system is a monumental step forward in safeguarding the country's economic future. Further, he said that the step to recapitalize banks has been taken at a time of sound macroeconomic conditions for the economy on other fronts. According to Urjit Patel's statement, recapitalization bonds will be liquidity neutral for the government except for the interest expense that will be incurred. Let's in fact bring in our in-house expert Latha Venkatesh, who is joining in to take us on all the details that have emerged so far on the recapitalization plan. Latha, what kind of impact is this capital infusion expected to have to revive the financial sector and the economy as a whole?
Well, I want to make 3 points. One, that this is a complete solution. 2.11 lakh crore meets all the requirements of banks for the next couple of years. The loan losses they have suffered, about 25,000 crore. The money that they will need for provisioning, about 1.5 lakh crore. And another about 1 lakh crore that they will need for growth capital for 2 years, say at 10%. Net of taxes, this is a complete solution. This brings the public sector banks straight into the market. Until now, they could not lend because they had deposit money, but the shareholder capital was not there. You know, every loan must have 10% of shareholder capital. That they did not have, and therefore they weren't lending. It was a field day for the NBFCs and the private sector banks. Now with public sector banks coming into the competition, interest rates can fall further because of undercutting, competition between more players. What happens to the economy? For the economy, the results are not going to be instant. One, the public sector banks are not going to lend today or tomorrow. It will take a while for them to resolve assets, to get the money and get back into the groove for lending. Until now, for so long, they've only been resolving or recovering. To get back into the groove of lending takes time. Secondly, there is disruption in the industrial space and the services space, and there is distress in the rural space. All that will not vanish. Of course, the trades, that is the exchange in which small companies can come and trade their receivables, is going to improve money flow. You know, big companies which are not honoring the bills of small companies for a very long time can't get away with it anymore. But all this will take time. Nevertheless, we can say with some certainty that a V-shaped recovery is possible for the economy in a matter of 1 or 2 quarters. Thirdly, what is the game ahead for public sector banks? This is what the government should not lose sight of. Yes, currently you have solved the problem of capital, but it can't be that banks make losses. Once in 20 years there is a recap bond and again banks start in their wayward ways. That can't be done. We have to use the moment to actually change the DNA of public sector banks, and that will mean not just HR policies, but one, bringing banks under the Companies Act, where you must have an independent board. The Banking Regulation Act is a pernicious act, and that has to be replaced by that has to be just killed, and banks have to be brought in the Companies Act. And finally, you need to privatize. There is no need for the government to own 14, 15, 20 banks. They need to privatize some, and even if they announce privatization, the prices of the current banks will go up, and that will mean they will be able to capitalize at a profit. So some more game-changing moves are needed from the government.
Okay, fair enough, Latha. So we can be prepared for a V-shaped recovery. Let's now go across to Ritu Singh to get a sense of how brokerages and rating agencies are reacting to the government's mega bank recapitalization plan. Ritu, you've done the number crunching. What's the word on the street? Will 2.1 lakh crore be enough to revive the public sector bank? And who really stands to benefit the most here?
Well, it's a thumbs up from the street all around. If you look at what the brokerages and the likes of Moody's have been saying, first up, they say it's credit positive for the sector that public sector banks' requirement will now be sufficiently covered with this recapitalization plan. They add that this will help the public sector banks regain some of the market share that they've been losing to private sector banks and NBFCs. In fact, Goldman Sachs says that for every incremental 100 rupee billion recapitalization into these banks, credit will increase by 1 percentage point and GDP will get a boost of half a percentage point. They also say that it will be supportive of the rupee and also add that the flip side is that with the growth reviving with this recapitalization, it's possible that the RBI may hike rates sooner rather than later. Nomura says this is a complete game changer for the public sector banks. It will lead to a re-rating in these banks. It also says that PNB is the bank that will benefit most given the fact that it is most sensitive to any capital infusion from the government. Morgan Stanley also says that the risk that banks would be a drag on the country's growth is removed with this plan. They also say that it will break that 5-year-long cycle of NPA buildup and the fact that it will accelerate provision with banks now having the capital strength to deal with the NPAs. And lastly, Macquarie says there will be no near-term change in the earnings ratings of these public sector banks. The risk premiums will also be compressed further, but what the need of the hour is really more structural reforms now to back up this announcement that the government has taken.